Hey guys, let's talk foundations. Today we're diving into a topic that might sound a little dry, but it is super important. It has implications on everything from your tax liability to how you manage operations. No pressure, right?
This is one of my most important / least important topics, but it is definitely one of those things that's going to really have a huge impact on your journey going in, and it's one of those things that you want to get right from the first. But before we get in, we know you guys are out there and you're busy and you're business owners, and it's summertime and you probably got kids running around. So before we get in, there's some free resources on the website that cover this and the other topics that we talk about, on every episode. So just head over to havensconsulting.com, click on that resources tab, and you can just download any of those free resources we got for you.
Yeah, all of the checklists that we talk about, all of the guides that we have, there's blogs that have in-depth information. So if you miss something, you can print that out.
Right.
Anything that you need is going to be on there. So let's break down business structure today.
All right. I guess I'm going to kick this one off.
Oh, for sure.
All right. So this is, like you said, this is one of the most important things because it defines how ownership works. It defines how your tax situation is going to be. It defines some tax benefits that you're going to get, or some tax consequences if you don't do things quite correctly. It's a very confusing topic for a lot of people, and it really doesn't have to be. So we're just going to kind of go through on the basic 3 things, I think, that are the main important things when people are forming that they want to know about. They want to know about complexity, they want to know about their tax situation, and they want to know about their personal liability. So let's start with the one, if you're out there and you are just beginning your journey and you haven't done the formation, let's talk about where you're at right now, and your sole proprietorship. I mean, anyone can be a business at any moment. This is where a lot of people start, and there's nothing inherently wrong with a sole proprietorship. It's, obviously pretty simple. You don't have to do anything, and it's also very affordable as it's free. So
there's no paperwork on that one?
No paperwork. You're just a person doing business. Okay. Now, as we talked about, I think in the last episode about like permits and stuff, you may still need a business license depending on where you live. So here in Texas, anyone can go do almost anything. I can't go practice medicine or anything like that, but for the most part, you can just go and be as a person. You file your taxes, you don't need an EIN, you use your social security number. And
so that would be like anyone that doesn't deal with TDLR, the Texas Department of Licensing and Regulation.
I really thought you meant people that just thought it was too long, didn't read. I was like, I guess some people just don't want to jack with it and they're just sole proprietors. I guess that's a thing. Yeah, so that's...
As a hairdresser, I had to have a license, right?
Right.
Cosmetology license. So that's who does that. So that's electricians and...
plumbers.
So anyone that doesn't need a license can have a sole proprietorship?
Even people that have a license, it's less common. Well, hairdresser or cosmetologist was a great example because most, you rent a booth.
Yep.
But you don't usually form an entity, right? So most hairdressers that we've worked with are sole proprietors, and that's probably good. I've had some questions from some of them, and this is one of the things we've seen a lot. Where do I need to form an entity? And of course, this is case by case. We look at everything, but typically for that profession, I don't recommend that you really need to form anything. There's not a lot of personal liability out there. So, short of cutting someone's ear off, but your salon probably has some coverage insurance.
And burning them.
But didn't even think about that one. But yeah, that's a very common example of sole proprietorship. Another one is individual, like lawn service.
Okay.
Not lawn companies, because usually they're formed, but
Just a guy that's mowing lawns for
Right.
money. Okay.
Right.
Got it.
Or if you're a teenager and you're just doing a summer, that you're a sole proprietor.
Okay.
You have a business and you'll need to file a Schedule C on your 1040. But the downsides here to a sole proprietorship are unlimited personal liability.
Right.
Your personal assets are part of the business because you are the business.
Mm-hmm.
So if you
Burn someone.
I don't recommend anyone that does on-site service ever do this. It's a huge risk that you take on. So if you're out there doing any sort of contract work at a client's location that involves any sort of physicality, we've got multiple insurance policies and we don't do anything physical. If we're on site, we're usually in a conference room. But we still have it, because if you get sued, if you go break something or hurt someone at a client site, your house, your cars, all your personal bank accounts, everything's up for grabs in litigation. That you have zero protection there.
Okay.
So that's the downside. Also, there's no legal, if you call yourself something, like if I'm Kenneth's Lawn Care Service, but I'm just a sole proprietor, anyone can come in and start using that name and register, and I have to stop.
Okay.
So usually people don't represent themselves as a company. They just use their name.
Okay.
But you can get a DBA as a sole proprietor, and you can do business as, which is usually much cheaper and simpler than
Starting a whole company.
Right. It's just literally doing business as, I present myself as this entity when I do business.
If you have a DBA, can someone use that name?
Not generally.
Okay.
You kind of reserve the right to use the name. It's like you're renting the name
Okay.
as opposed to purchasing it. That's not a direct analogy there, but because you have to renew that DBA certificate. If you form, say here in Texas, you have to continue with filings, but you don't have to reapply for your name.
Okay.
You just make sure you file your beneficial ownership and franchise tax if you owe it, and your account stays active and you get to keep your name. DBAs here in Texas, there's two types. You can do it through your county, and you'll see a lot of, you're like, I feel like I've seen, my favorite example, Mexican Inn. I feel like every town in Texas has a Mexican Inn. And I think they were ran by the same family, but that's probably just a DBA or some not cool sounding name like the Havens Family Investments LLC. You don't name a restaurant that.
Yeah.
But if that's who owns it, you'll do business as Mexican Inn. So you may see that across, and those are probably county filings.
Okay.
So those are filed with their counties, and those don't really affect each other. But you can do a statewide filing with the Secretary of State. And then you've kind of got that name for the whole state.
Okay.
So that's sole proprietorship. One more bullet point that you did have here. It is really hard if you're trying to raise capital.
Oh, yes. Okay.
So even getting a loan, because here you're probably not getting investor financing, no equity financing, short of maybe some close relatives.
Right.
But even getting a loan as a sole proprietor can be a little more challenging.
Okay. Yeah, because of the liability.
Right.
Right. Because if they loan you money and something happens, then.
Well, if they loan money to a company and something happens, that company has still got the loan, and they could still be liable. But it's just the more structured and established your business is, the easier it's going to be to get financing.
Okay.
So the next type, which is I'd say the next simplest type, and we're not going to get into some of the more exotics like professional limited liability companies or professional partnerships or anything like that. We're just going to.
If you have questions about something like that, you can see if we have any resources on it on the blog, or you can email info@havensconsulting.com, and we will answer your questions on the show later on.
Yeah, I love to learn new things, and this is one of my favorite topics because it's very
boring
and it's very rigid and predictable. That's how I like to describe it. But yeah, if you've got a question, if you've got a unique situation, we had some nurse practitioners talk to us, and we kind of pointed them down the road of a professional liability, which is broad strokes here. if you and all the owners have the same state or federal certification that's required to do your business. So if you're all lawyers, if you're all accountants, if you're all doctors, if you're all whatever, you can form a PLLC, and it's got a little bit of different benefits and structure, but every owner, you can't have outside owners that aren't whatever you are. So it's kind of a niche structure type.
Yeah.
So we won't really get into that one. So the most common one you're going to see outside of a sole proprietorship is a partnership. And this is not really a lot different than a sole proprietorship, other than there's more than one person. In terms of liability, we have what are called general partners and then limited partners. So if you materially participate in the business, which means, are you working in the business daily? Are you kind of managing or performing the normal duties? You're a general partner, and general partners have unlimited liability. They have sole proprietorship level liability. But then the limited partners, there are some, if say you want to invest in a company, but you're not participating in it.
So someone gets money from grandma.
Right. Yeah. Right. Great. And so grandma's a limited partner. Grandma's risk is limited to the amount she has invested. So which she's already invested. So basically nothing else can.
There's no more liability.
Right. She'll just lose everything that she had. Typically, and we'll talk about a phrase I think a lot of people have heard, maybe a little, what's that? Is piercing the corporate veil. And we'll talk about that here in a little bit. And when these liability protections kind of evaporate on you. So in a partnership, they're really easy to set up. The taxes are not really complicated. You are going to enter, we talked about on a sole proprietorship. This is just a schedule on your normal 1040 that everyone files every year, hopefully. But a partnership, now we're getting into our business has its own return. So partnerships are going to file a Form 1065. It is a partnership tax return.
At this point, you are a legal structure, so you've filed with the state and you have an EIN.
Right. And if you have any questions about that, check out our last episode. We went through how to do this in probably too much detail. I talk to a lot of clients about this a lot. This is one of the most important decisions you've got to make. We've seen some kind of flippant decision making on this topic. People get real excited. We get that. And they just kind of, I'm going to form a company and blah.
Right. Or they see something on TikTok, your favorite place for advice.
And we'll talk more about TikTok accountants when we get to S Corps here in a minute. S Corps have probably caused me and people that we have encountered more heartache than any other structure. So on partnerships, you're now filing a separate form. You're filing your 1065, and it's important to know that for partnerships, for S Corps, LLCs, if they're taxed as these things, and we'll talk about LLCs here in a minute as well. These are what we call pass-through or sometimes flow-through entities.
Yeah, I've heard the pass-through a lot.
So all that means is your business doesn't actually pay taxes. Your business makes a net income or a net loss, and it passes that through to its owners. So we're all used to getting a W-2 from our job. If you have an ownership in a partnership, an S Corp, a C Corp, PLLC, anything like that, you're going to receive at the end of the year a K-1. Just think of it as your W-2 for being an owner. That's essentially what it is.
That's the same form for investments, right?
Yes.
And it works the same way if you made money on an investment or lost, I suppose. You would get a K-1 from that company and then pay the taxes on that.
Yes. And the reason that those are the same form is because if you do invest in something like that, you have a partial ownership in whatever that investment is. Not always a company. Sometimes it's a fund that which is essentially a partnership of a bunch of people that own one or several other businesses.
Okay.
But at the end of the day, it's going to be, there's a person somewhere that owns an operating business somewhere. Now, there may be 8 layers in between.
Right.
But yes. So that's why you get that same form. So your tax situation is going to get a little more complicated, not crazy.
With the partnership.
Right. Because you're going to have a second filing and expect that to be more than your 1040. And expect that to be a lot more if you're not keeping up with your bookkeeping.
Mm-hmm.
So, and we'll talk about bookkeeping in another episode, but that is super important to make sure you stay on top of that or hire someone to do that because it'll be a lot more expensive in the long run. But partnerships, you want to make sure that you've got a well-established partnership agreement here because now that you've got business partners, you need to, and we talked about this in the last episode, make sure you've got all those resolution or dispute resolutions and ownership transfers all lined out on how that works, who's got first rights, all that.
And who is liable for what.
Right. And how much each partner owns. And this is where it can get a little confusing for people. And this is going to be true for all the structure types I'm about to talk about. So we'll just kind of lay this blank caveat out there. The amount you invest into the company does not necessarily represent. So if you put in 10,000 and I put in 90,000, we can still be 50-50 partners or 90-10 or whatever.
Right. So let's say grandma puts in 90,000 and I put in 10,000, but I'm doing all of the work, but she's got all the money. So we can decide what percentage owns the company.
Right.
Okay.
And definitely want to hash out what that is before money transfers, have that discussion, get that in writing, have that operating agreement signed and established. Because yes, running the company as opposed to a limited partner, you are providing a different economic benefit outside of the cash. You're the ongoing operation. There doesn't have to be any rhyme or reason to it as long as all the people that contributed money and the owners agree to it. So y'all can divide that up. And we're not going to get deep into tax law here because we'll go off on a weird tangent.
Making faces.
Yes. There's different bases. So there's liability basis, there's your capital basis. So
do your research
or talk to a professional. It doesn't matter what you put on that operating agreement when it comes to taxes. This is a separate kind of ownership. It's usually the same, but especially if people put in more money down the road, now you've got this all has to be, there's inside basis, outside basis. We won't get a tax law, but
talk to a tax professional.
We've actually seen just recently, we had a partnership buyout, and that can get really complicated. So again, very good bookkeeping and just keep good records. But for your partnership,
what are the pros?
Pros are you have an established name. You have more of a established separation of your personal and business.
Okay.
It's got its own tax form, which a lot of time, if you're getting loans, it's easier and kind of, well, not easier, but it's a little nicer to just be able to send them your business ones instead of your personal return with those all back there. And so the tax returns are much more detailed, and it gives you basically an establishment and an entity that can operate as an individual when you have more than one person. Outside of that, unless you're a limited partner, and we talked about that earlier, you're not going to get any sort of protection here.
So that would be the cons.
Right. So the next one we're going to talk about is C Corps. And we're just going to brush over this because, again, we're not talking to what we call startups. We're talking to small businesses. And this is not a structure type that we see a lot in small businesses. And the reason it's the main type that you'll see that does pay taxes.
Okay.
So a C Corp will pay taxes on its own. And then any dividends that you get or distributions to you on top of that get taxed again. So there's double taxation.
Okay. So the business or corporation gets taxed, and then each owner would get taxed for the portion that they received.
Yes. Now, if they didn't receive any, they don't get double taxed. But eventually you're going to want that. You want your investment to cash out somehow.
Yes.
So that particular tax rooster will come home to roost at some point. And the big question I get on this one is, well, then why would you do it? Because it offers the highest level of litigation protection for the owners.
Okay.
You can't really sue an owner of a corporation unless this is where we talked about piercing the corporate veil. And I'm sure there's a lawyer out there that's like, well, actually, there's probably about 50. And it's like, yes. And they're probably all nuanced versions of these two. And there may be some other more exotic.
Yeah. And if you have some information, if you are a professional in anything that we talk about, we would love to hear from you as well. We love, like Kenneth said, we love to learn new things. So
Absolutely.
Please send us over info@havensconsulting.com. We would love to hear from you.
Absolutely. So that piercing the corporate veil, if let's say you are a shareholder in the company, you're also upper level management.
Okay.
And any publicly traded company you see is a C Corp.
Right.
That's not the company that operates. Often that corporation that you own doesn't do anything other than own a limited partnership that does everything.
Okay. All right. I think I know what you're saying. So is that like when you have a holding company?
Yeah. Yes. So let's say you buy Alphabet Inc., which is Google. That's their holding company.
What is it?
Alphabet Inc.
Okay.
You own stock in Alphabet. Now, Alphabet owns a couple of different companies. It owns Google. It's got their AI. Because if companies separate out their lines of business into separate companies, they'll have this one company you're buying stock in that wholly owns all of these things. Mm-hmm. And so you do still have the ownership just through an additional layer.
Got it.
Because you can't buy stock for anything other than a corporation, because corporations are the only ones that issue stock.
Okay.
Partnerships just have an interest,
right?
A partnership interest. So C Corps do offer that high level of litigation protection. Mm-hmm. And those two main circumstances where it's not going to do that, where you're going to pierce the corporate veil, is if you do something that is negligent or fraudulent, then the court may decide that, hey, now you materially participated knowingly or negligently in whatever happened that you're getting sued for. So, no, you are personally liable. The other, and this is kind of a two-prong, if you don't keep good records and your personal and your business funds are so intermingled and intertwined, the court can't figure it out. They'll say then it's all the same.
Right.
We're going to treat all the assets to be company assets.
And I think we've said this in every single episode so far, and probably every episode where we talk about back end of business ever. Make sure that as soon as you have your paperwork in, you get a separate bank account. Even if you haven't started with your software or Excel or tracking, make sure you have a separate bank account where the money for the business is coming in and out.
Right. And one of the questions we'll get a lot is, well, then can I not move money back and forth? You absolutely can. Just keep track of what it was for and why you did it and where it went. If so, again, it's if the records are so muddled or not available, they weren't kept or whatever, and there's not a reasonable way to untangle this knot of information that's been formed, then they'll just say, well, it's all on the table then.
Right. Like I've gone to Walmart and I had to buy stuff for our house. Obviously, everybody goes to Walmart. And for the company as well. So I had to do 2 transactions. I did one on my business card and one on my personal card. But if I had done them on the same card, there's no way to tell if those highlighters were for work or because I super love highlighters and I need them for everything at home as well.
Right. Unless when you track that expense, the business part gets expensed and the other parts go as essentially equity distribution.
Okay.
And what you'll see a lot of times in some of the, like QuickBooks or Xero or something, they've got an account called owner's personal expenses, and it's in the equity because you don't get to expense those personal items, but cash went out, so it's going to be accounted for somewhere. So it's It's just like if you took cash out of the business and then bought those things.
Okay.
So it's just a distribution to the owner. And as long as you're keeping good records of this, then that's totally fine. It's a lot easier if you do
2 transactions.
right, like you said. I mean, it's not necessarily easier in that moment, but for record keeping, it's a lot easier. So that's your liability protection there with C corps. That's, like I said, really the highest level you can get. But then the taxation is not great.
Right.
It does offer a lot easier way, and this is why, again, publicly traded companies are done this way. If you're trying to raise equity financing, it's so much easier. And we won't get into preferred stock, common stock, voting rights, all that.
Oh, please don't.
But you can just sell stock. You can issue new stock. Now that will cause a dilution of shares. So basically, if we each own 50% of a company, but we want to raise some capital and we sell half the company, so we just issue the same number of shares that are out there already that we own, we now become 25% owners and that person becomes 50. That does happen sometimes, especially when companies are about to do a large R&D project or something, or if they're in distress and they need to raise some capital. The existing owners don't like it because their share
diminishes.
Right. Their stock splits, but that doesn't dilute anything. Your shares are worth, like if you do a 2-to-1 split, your shares are worth half what they were a second ago, but you have twice as many as you did a second ago. And that's just if there's not really a lot of shares available that adds those shares out there in the market. Anyway, kind of went out there in the left field on
my eyes started to glaze over.
So on C corps, double taxation, great liability protection, easy to raise capital, pretty complicated to not really complicated to form, but you're going to have some ongoing requirements. And a lot of this is going to be, everything I've said so far is true for S corps except for some of the ownership things.
Okay.
And we'll talk about that when we talk about S corps here in a second. So raising that capital, real easy, all that. So let's kind of move into S corps, and these are the bane of my existence. I don't hate S corps. S corps are great. And depending on your situation, they can really save you a lot of money tax-wise.
The problem is most people don't understand all of the requirements of an S corp when setting up. And from what I've heard, I don't usually deal with this kind of stuff, but they don't know all that's required of them, and they're not great for small business owners who are just starting out, who don't have a lot of capital.
Right. Everything you just said was absolutely correct. This was the one question I asked because there is a lot of benefit there. But if we're talking to someone about forming a company, a lot of people are like, well, I heard S corp's great. I want to do an S corp. And it's the question I ask, can you pay yourself a reasonable salary?
I knew that's what you were going to say.
That's the big question, right? And they go, what's a reasonable salary? And I'm like, well, that's another fun question because the IRS doesn't define that.
Right.
If you really want to kind of have a backup, have someone that knows what they're doing do a reasonable salary analysis. So we do these. We use various sources, Bureau of Labor Statistics, some local, more private companies that kind of aggregate what your job is at this industry, where you are geographically, and what do these people typically get paid. And the reason, go ahead.
So this is something you shouldn't just ask Google?
No, this is not something you want Chat GPT doing for you or something like that. You want to make sure you talk to someone. I've seen some people do their own reasonable salary analyses, but you certainly can. Just do your research, make sure you know what you're doing. If you start feeling like the waters are getting a little murky, call a professional.
Yeah.
So if you don't have a reasonable salary, and I'm going to, before people start, chumming the water in the comments section down below, this is going to be a 50,000 foot flyover. I know there's a lot of nuance of what I'm saying. There's a lot of more detail here. So I do know that, but this is for someone just starting out.
Yep.
So
just looking at the beginning research, looking at their options. Again, if you have questions, concerns, more information, or a differing opinion. We are open to all of those, and you can email us.
Absolutely. If you can pay yourself a reasonable salary, there's definitely benefit there because you can get some cash or some tax redistributions post paying yourself a reasonable salary and covering those FICA expenses, Medicare, Social Security, your self-employment taxes. And then you can have some more distributions after that up to your basis that are tax-free.
Okay.
What happens is people form these brand new companies. They don't have a lot of capital. You know, it's a side hustle or whatever, but they do an S corp because some TikTok accountant.
I was just about to say TikTok told them to.
Yep. And they form this business and maybe they sit on it. They don't even do anything with it. Or they are working, but they can't pay themselves a reasonable salary.
Which most small business owners can't pay themselves a reasonable salary. I know for sure we couldn't pay ourselves a reasonable salary when we started out, and I'm sure that there will be an episode all about that adventure.
Yes.
I would say most people can't do that.
Right. Most of the people I think that we're going to be speaking to here and, you know, that'll run across our videos, they're not going to be in a position to pay themselves a reasonable salary. We hope you are very soon.
Yes.
But you probably aren't from the onset.
Right.
So just be aware of that. And I'll kind of talk about a strategy that I usually recommend to clients or, you know, just consultations that it'll make it a lot easier to take advantage of that later on without giving you all the heartache right now. And the big problem I've had some really rough conversations with some people about this. They come to me.
5 years.
Yeah. 5 years of not filing or whatever. Well, the 5-year look back does not apply to this. There's and this is one of the crazy things about it. The IRS doesn't have a limitation on how far they can look back. So they're going to look back to the inception of your S corp. And then they're going to say, all right, here's a reasonable salary. Any tax-free distributions that you took and you were short or didn't pay yourself at all, they're going to say you should add a reasonable salary here. So you owe payroll tax for these. You also owe all the fees and the late penalties and the interest. And they're going to do that for every year. And they're going to remove any tax-free distributions you did, put them into that category. And I know one of the questions I get asked a lot, well, I don't have to do that if I can't pay myself. You absolutely do. You're required to pay that's why I tell people, if you're not in a position to do it, don't make an S corp.
Right.
All you're doing is making your tax situation horrible.
Yeah.
So just don't.
So let's say I started up a business and I've been running it for 5 years and I've barely made anything. Just breaking even. I mean, maybe money's coming in, but just as much as going out.
Right.
I still have to pay myself a reasonable salary for those years?
You are liable for the payroll tax for a reasonable salary for all of those years.
Okay.
And interest, underpayment penalties, other penalties.
So it's not the actual salary that I owe, but all of the penalties and fees and payroll tax associated with what I should have.
Yes. And the reason that this whole reasonable salary came in was, of course, it was an accountant. Back in 2001, I don't remember the exact numbers, but I think he made like $350,000 that year, which was, you know, that's like a $600,000 a year now. And his reported salary was $20,000, and then he took the rest as a tax-free distribution. And a judge said, absolutely not.
Yeah.
No.
Yeah. You can't make $600,000, but say you only and pay taxes on only 20.
Well, you can if a reasonable salary for your position is $20,000. But the argument there was a reasonable salary for a CPA was not $20,000. I think they bumped it up at that time to like 120 or something. But they can go back and that whatever number they pick.
Yeah.
You know, if you don't have a good defense against it, and that's why we always do, if we're going to set up an S corp, we're almost going to require you that we do a reasonable salary analysis that you're going to keep with your formation paperwork.
I mean, better safe than sorry.
Yes.
And this is really structuring your business is the most important thing that you can do at the beginning for yourself.
Right.
Maybe not for your marketing or your clients, but for you, the person who owns the business, this is absolutely the most important part. Most people think about the name. Well, your name doesn't matter if you owe the government $1 million.
Right. And another thing we ran into a lot is when we try and explain this to someone that's a year to 5 deep into this situation, well, so-and-so told me I could do this. Well, so-and-so was wrong.
Yeah.
And there's a lot of that's the whole reason we're doing this podcast, because there's so much bad advice out there.
Yes. And contradictory.
Right.
I mean, every video that we've made, you could take any point that we have made on this show and you could find a video saying the exact opposite.
Right. Yeah. You can find evidence of every counterpoint.
Yes. But we've done 3 years of research and doing it the right way and doing it the wrong way on all this stuff. As far as we know, everything that we tell you is exactly the truth.
I'm pretty confident, especially on this topic. I'm kind of constantly in the middle of something involving this for the last 3 years, constantly. So on S Corps, you got the reasonable salary that you got to have. Now there's some limitations. A C Corp can have as many owners as you want. Anything can be an owner. It can be people. It can be other companies. It can be trusts. It can be anything. Anything can own a part of your C Corp. S Corps, you are limited to 100 owners. And so for a lot of small, what we are calling small businesses, that's not a problem.
Right.
But it basically keeps, because C Corps don't have those tax benefits, and it keeps large companies from saving billions on taxes through these tax-free distributions. Also, every single shareholder, you would have to divvy out the earnings to each shareholder instead of just the corporation paying its taxes,
right,
and then you paying on your dividends. I mean, imagine if Amazon had to send K1s to every shareholder. People that own like a third of a share on Robinhood or something, they fill up this building with K1s. So 100,
we would get one.
We would get one. So 100 owners. There are some exceptions. There's qualifying sub-S corporations. They're generally sub-S is the technical name. It's subchapter S of tax code. That's where it gets its name. Is an S. Yes, I know.
Making faces again.
So you can have a qualifying sub-S, which just is usually an S corp owned by another S corp, wholly owned by another S corp.
So that's 3 layers?
If you include the individual owners, yes.
Okay.
So it'd be like if I owned an S corp that wholly owned another S corp, I could do that.
Is that like a holding company or different?
Kind of. Holding companies, the term holding company gets used incorrectly a lot. People use it for umbrella companies, which is usually what they're referring to. An umbrella company holds ownership of other companies.
Okay.
And kind of brings them under one umbrella.
Right.
A holding company is usually a separate company that holds the major assets, but does not do business with anyone other than the company who it holds assets for.
Okay. So if you had a trucking company, the holding company would own the trucks.
This is a beautiful example. That's exactly right. So
I listen.
Yeah. So they'd hold the trucks. They would lease those trucks. So if you had Havens Truck Holdings LLC, and that owned the trucks, it purchased the trucks, it did all that, and then it leases it to Havens Trucking Company, then that's the operating company, and then you have the holding company. And the reason that exists is because it kind of acts sort of like a trust. So if that holding company, you can't sue a business that you don't do business with. Right. So the holding company doesn't do business with anyone other than the operating company. Right. So it's unsuable. But if you can sue the operating company, but they're like, oh, you sued us and won. We're filing bankruptcy because we don't have anything, but they don't lose anything. Right. Because they just go form another one and do the leases to that one. And they usually just do whatever their company name is right now and add a 2 at the end. Yeah. And they'll usually be running that company before the bankruptcy hearing even starts. Right. So that's definitely That's what a holding company truly is. Umbrella companies are usually what people are referring to when they say holding company.
Okay.
So we talked about limitation on what type and how many shareholders, the reasonable salary. Now, once you get to a point where you can pay yourself a reasonable salary, it's a great structure. And again, we don't just recommend something to someone. If someone is telling you this is what you should do and they don't have any idea what your situation is, that person is not someone to listen to.
Right.
There is no universal blanket anything.
Yeah.
That's why we do a deep dive on your situation and then give you the best recommendation for your situation.
Yep.
What usually works for people, this hasn't been always the case, but what we'll usually find, because we deal with a pretty consistent pool of individuals, small businesses, and they're just starting out, or they're a year under 5 years old generally. So if you're going to set up a legal company, maybe you've been running as a sole proprietorship for a few years or whatever, we'll recommend doing an LLC, a limited liability company, or limited liability corporation. They're different phraseology depending on your state.
Right. Yeah, I think everyone's heard of an LLC.
Yeah, let me go back one step. We talked about how the partnership has its own tax form. So does a C Corp. They have an Form 1120, and S Corps have an 1120S. LLCs, not recognized by the IRS.
Okay.
But you can get one in all 50 states. So when I say not recognized, it doesn't have its own tax structure.
Okay.
So it's a legal entity, but it has to be taxed like one of the others.
I see. So no matter what, most companies have an LLC, but then they pick one of the other things for taxing.
Yes, within the options that are available to them.
Right.
So obviously you can't have more than one person be taxed as a sole proprietor.
Right.
You can, but you have to be married, you have to file a joint return, and you have to be the only two owners. And then you can still be taxed as a sole proprietorship. And this is where you'll hear the term disregarded entity. You form an LLC, and it gives you limited liability. Okay. And going back to our partnerships, limited partners are their risk is limited to their investment. As a limited liability company, the owners, which are called members, are limited to their investment as far as their liability goes.
Okay. So if you put in 50,000 and I put in 50,000,
and someone sues us for $1 million, the only thing we can lose, barring some of the exceptions we talked about earlier and some other things, we're just out that investment. They can't come after our personal assets, can't do that. So it gives you a limited liability, not an absolute liability, of course. And like C Corps, there you can actually recoup some of your investment, especially in like bankruptcy and stuff like that, probably pennies on the dollar. But you have a little bit even better liability protection there. So the limited liability company, you're going to elect to be taxed as a sole proprietorship, like we said.
If it's just you.
Just you.
Or you and a spouse that file together.
Right. And you're the only ones. And the IRS, be very careful when you're setting up your EIN for an LLC. If you click the wrong checkbox, you're now a different entity type. And you can change this is why we recommend it. Because if you form a partnership today and in 2 years, you're like, we want to be an S Corp. Well, now I have to dissolve your company. We've got technically, there's a transformation process there that's a lot more cumbersome because you're going to be filing a new tax form. So your existing basis is going to be different, and there's going to be some different complications that happen there. But if you form an LLC and decide to be taxed as a disregarded entity or a partnership, down the road, you're like, hey, I think we're at a point we can pay ourselves these salaries. We qualify. I think we want to be taxed as an S Corp. Now I just have to file one form.
I see.
But you can only do that once every 5 years.
Yes, that has been a problem with some people we've worked with before.
Because they formed it really the correct way, and then someone on TikTok was like, or they've got that cousin that...
And maybe they were trying to help.
Right. Yeah, but just
Talk to a professional.
yeah, talk to a professional, know your sources,
Also, even if you talk to a professional, please do your own research
Yeah.
because, especially when you're first starting out, this happened to us. This has happened to every small business owner I have ever spoken to. You think someone is a professional. You think that they know what they're doing. They tell you to do something. You do that thing, you find out that is absolutely not the right thing.
Absolutely.
So just because you've talked to one person, still do your research. I mean, check our work, check everyone's work,
Right.
check your own work. Make sure that you're doing things correctly, especially your structure.
Yes. Or your tax returns.
Yes.
Please read your tax returns before you approve them.
Yes. Read every line of every page. Take a few days if you have to,
Yep.
and read one page at a time.
Yep. And just make sure that everything's there, everything looks right. You don't have to know all the nuance. Just make sure no numbers look crazy. But that's a separate topic. So if you want to restructure this now, it's a lot easier. But you're going to get all the tax, because you're going to be taxed and fill out whatever tax form you elect or are allowed to elect. Now, there's defaults, which the only defaults are partnership and disregarded entity. And the IRS basically just defaults to however many owners there are, or members or whatever, when you get your EIN as an LLC. Now, you can make elections. I think it's an 8853. I don't know. There's a tax form that you make your election to be a corporation if you want a C Corp or an S Corp be taxed that way. As an LLC, I don't know anyone that chooses to be a C Corp, but that's how you set that up. And because it gives you the same liability that a limited partner has, or even really a shareholder, I mean, you're kind of limited to your investment, as in most cases. Disclaimer here, I am not a lawyer. This is not legal advice. You get that protection, but then you get the versatility of changing that tax structure very easily, as opposed to turning a true partnership into a true S Corp, because your company is still an LLC. You've just changed your tax election. That's why it's much simpler. So that's usually the route we send people down. That hasn't always been the case. It's the most common one. But again, this is always a case by case. So if someone's giving you blanket advice, you're playing the lottery.
Yeah.
Their advice might be your best situation.
But it might not.
It might not. In fact, there's a good chance it's not, because there's so many options here. I know I went way off in the weeds there. That's a topic that's really hard for me to stay on the basics on, because I feel like I'm talking to someone about it every day.
Yeah.
There's some...
And you're like, but this.
Right. Because you run into some people sometimes as a consultant that they come to you for advice, and then they'll let you know how they know more than you do the entire conversation. And that's fine, but you don't need me then. So we definitely run into having to explain to some people, this is why we do this. This is how this works. And so these are things to take, just make sure you do your research. You're going to hear that all the time on this podcast. Do your research, check your sources. And to your point earlier about, checking the work of professionals, I always have our clients check my work on anything, because I'm a human.
Right.
I try and put as many fail safes to make sure that things are correct in place. So some key considerations here with these different types are, again, liability, the taxation, the complexity, and then how you're planning on raising capital. I didn't really get into a lot of the post-formation requirements that corporations have, like annual meetings and minutes and of shareholder meetings and stuff like that, but we can get into that in a little more detail in a later episode if people want to hear more about that kind of stuff. But that's really it. Those are your main types if you're starting out. I mean, there's joint ventures and stuff like this. But if you're getting into that territory, you're probably well aware of what you need to do.
Right.
Or you've got a lawyer doing this for you.
These are just the basics.
Yeah. This is going to apply to 99% of, new small businesses. This is going to cover 99% of y'all. I say 99% because we did have a co-op once, and that was a whole crazy learning experience for me, because I had never dealt with a co-op before. Then there's nonprofits and stuff like that. Those are just some of the things to look out for. What's your risk tolerance? What liability can you take on? How many owners are there? What are the roles of the owners? How are you going to raise money? How easy does it need to be to transfer ownership? Because that's another benefit I didn't really talk about on corporations. If I want to sell, I just sell my stock.
Right.
And like if it's publicly traded, it's super easy.
Yeah.
Because you have market makers that'll just buy it from you and sell when someone wants it. But partnerships are a little more difficult, and sole proprietorships are really impossible. You just kind of transfer assets, and it's an asset sales. But so these legal entities do give you some added benefit of transferring there, but those are the things to consider, think about.
And like we said at the beginning of the episode, there are notes on our website. They're completely free. You can look those over. That'll give you a broad view, and then you can do your own research to get some more information on them. And then, like we say, just hire a professional.
Yeah. And if you've got questions or you heard something here that didn't really make sense to you, or you think is incorrect, or it may be, like I said, I'm not perfect. I'm pretty confident in this information. I feel like I've done this enough times, but if you've got a question or something, just let us know. Stick it down there in the comments, and we'll see what we can find out for you.
Yep. And if you want to talk to us about helping you set this up, you can schedule an appointment from our website, book a consult. You'll talk to Abby. She'll get you going on that, and we'll talk to you soon.
Yeah. All right. Well, thank you guys. Until next time.
Bye.